Welcome to all. I am Dr.R.RADHA, Assistant Professor in Commerce, Bharathiyar Arts and Science College for Women, DEVIYAKURICHI, Attur. Now I am going to discuss about basics of income tax. Before entering into the topic about income tax, we should know something about what is tax. Tax means nothing but it is a compulsory extraction made by the central government from the general public. Tax is not a voluntary contribution or donation, it is an enforced one. That is, we cannot pay as per our wish. Everyone should pay whatever we need to pay as per the Income Tax Act 1961. Income tax is a financial charge imposed by the government on the income earned by the persons. This income tax, whatever the general public pays to the government, is a main sources of income. The government will spend the same amount in many projects for the welfare of our society or the peoples. Now we will see what are all the types of taxes in India. The taxes are two types, mainly classified into two types. One is direct tax, another one is indirect tax. What is direct tax? Direct tax means nothing but when the liability and burden of tax lies on the same person is called direct tax. Indirect tax means the liability and burden of tax lies on the different persons. The following is the examples of direct tax, that is income tax, tax on agricultural income, and then professional or employment tax. Income tax means nothing but it is an amount paid by the peoples on the income earned by them. It is levied by the central government. The authorization is only in the hands of central government for collecting the income tax from the peoples. Next one is tax on agricultural income. The power lies in the state government to collect the tax on agricultural income, but in India, agricultural income is fully exempted from tax as per the Income Tax Act 1961. Then the third one is professional tax or employment tax, which is also power lies in the state government. Now we will see the examples of indirect taxes. Goods and services tax, customs and excise duty, and then securities transaction tax. Goods and services tax means, for example, when we are going to a jewelry shop to buy a gold ornament, we should pay price along with the goods and services tax. Here, the tax burden belongs to the customer and the liability to settle it to the government is shopkeepers. In this case, the burden and liability lies on different persons, that is both customers and then shopkeepers. These types of tax is called as indirect taxes. Next, we will see the features of income tax. Under features of income tax, first one is levied as per constitution. Our Indian government or our Indian constitution authorizes the central government to levy tax from the general public. Second one is levied by the central government. Central government is only an authorized body to collect tax from the general public along with the help of the income tax department and Ministry of Finance. Next one is direct tax. Income tax is a direct tax. As already we said, direct tax means nothing but where the liability and burden to pay tax lies on the same person, means it is called direct tax. Next feature is annual tax. Income tax will be paid annually and not at any intervals. Tax on person. Income tax is collected on the person's income. As per the Income Tax Act 1961, the word person includes individuals, companies, partnership firms, association of persons. Association of persons means nothing but where group of people combine together for a common purpose is called association purpose. This all the categories comes under the word persons. So, Income Tax Act 1961 prescribed persons as individuals, partnership firm, companies, association of persons, and so on. Next one is tax on income. Tax is charged only on the income earned by the persons. So, what are all the incomes means whatever a person earns will comes under any one of the five heads. What are all the heads means salary, house property, business and profession, capital gain, and last one is other sources. These are all the 5 heads of income. Whatever the sources of income a person earns will comes under any one of the above heads we said. Next thing is income of previous year is assessable in assessment year or next year. So previous year income only calculated for the payment of tax in this current financial year. So every current financial year starting from the 1st April to 31st March. So this is the assessment year. In this, the government's current financial year is always called as assessment year. The assessment year is income tax calculating income on the income earned by the peoples for previous year, preceding years. Next thing is charged at prescribed rate. The rate of income tax differ for different incomes. For normal incomes, the rate of tax is fixed by the Finance Act. For casual incomes or special type of incomes like long-term capital gain or casual incomes, like for example, winnings from horse races, winnings from lottery tickets, these are all called as the casual income. For such type of incomes, the rate of tax is fixed by the Income Tax Act 1961. The next one is administered by the central government. Income tax collection process is administered by the central government with the help of income tax department. Then last feature is applicability. Income tax is applicable all over India in our country, including Jammu and Kashmir. Next we will see who is called as assessee. Assessee means nothing but assessee is a person who is liable to pay tax. So, assessee is a person who is liable to pay tax. Here already we said the word person includes not only human being but it also includes companies, partnership firm, association of persons, Hindu, undivided family and so on. Assessees are mainly classified into 3 categories. One is ordinary assessee, second thing is representative assessee, third one is assessee in default. Ordinary assessee means those who are filing the return in time, those who are paying tax to the government in correct time, they are called as ordinary assessee. Next thing is representative assessee. Representative assessee is liable to pay tax on his or her own income as well as to the others. For example, if a person acting as a agent of minor or lunatic or non-resident Indian, in such a cases, such a person who is acting as an agent needs to pay income tax to his own income as well as to whom he is acting as an agent. So they are called as or comes under the representative assessee. Then third one is assessee in default. If suppose any one person is fails to pay tax or file tax return in time to the government, they are called as assessee in default. Next thing is we are going to discuss about what is assessment year and previous year. Already we said assessment year means nothing but tax calculating year. Every financial year, every current financial year of the government is called as assessment year. Normally, assessment year always starts with the 1st April and ends with the 31st March. Okay, so next we will see current assessment year. Current assessment year is 1/4/2021 to 31st March 2022. Assessment year means nothing worry about. It is a tax calculating year. Next we will see the previous year. Previous year means nothing but income earned year. So preceding current previous years or preceding the financial year's income only, we are calculating the tax to pay the government. So previous year means nothing but immediately preceding the current financial year of the government is called previous year, or otherwise it will be called as income earned year. Next we will see gross total income. How we will calculate or what are all the things will include in the gross total income. Gross total income includes 5 heads. First one is income from salary, income from house property, income from business and profession, income from capital gain, and last one is income from other sources. Whatever the sources of income a person can earn, but they all the incomes will comes under any one of the heads. So first head is income from salary. Income from salary means if a person employs as an employee in a concern, he gets monetary emoluments as well as non-monetary emoluments from the employer. Whatever he gets, whether it may be a cash or non-cash benefits, which all will include in the income from salary. Then second head is income from house property. If a person owns more than one houses means he uses one house for his own residential purpose and another one house or two houses may be for let out. In this case, the income or rent from the let out houses is called as income from house property. Then third one is income from business or profession. A person can earn income from house property or income from salary as well as simultaneously income from business or profession. Suppose he is doing any business means the profit from such a business will comes under the get income from business. Suppose he is a professionalist, say for example doctor or lawyer, their income, professional incomes are also comes under this third head, income from business or profession. Then fourth head is income from capital gains. Income from capital gains means nothing but if any assets we are selling, the income or the gain or the profit from such a transaction or such a process will comes under the income from capital gain. The capital gains are classified into two categories. One is long-term capital gain, another one is short-term capital gain. All the gains will comes under the income from capital gains. Long-term capital gain means nothing but if a assessee holds or if a person holds such a asset more than 36 months from the date of purchase means it is called long-term capital asset. If he tries to sell or if he sold such a asset and earned something from that process means it is called long-term capital gain. And the second thing is short-term capital gain. When a assessee sold a asset within 36 months from the date of purchase, it is called short-term capital gains. There is a possibility to earn losses also. We cannot say any time the income only arises. Sometimes a person or a assessee may suffer 5 losses. There is a provision to adjust the losses in intra-head or inter-head incomes. Then last one is income from other sources. This head includes the casual incomes like winnings from horse races, winnings from lottery tickets, winnings from crossword puzzles and so on. Next, gross total income. By adding together the incomes of various heads, we can get the gross total income. Before that, if the losses arises or if a person or assessee suffers losses from any one of the head means there is a provision to adjust that losses from the incomes. Such a adjustment may be intra-head incomes or from inter-head incomes. So, by adding together, after adjustment, by adding together all the heads of incomes, we will get the gross total income. From gross total income, we can derive the taxable income. Taxable income means nothing but from the gross total incomes, there is a provision or the Income Tax Act 1961 provides some provisions or exemption to reduce the tax payment or to exhibit the savings habit among the peoples. So, deductions 80C to 80U are the provisions to deduct the amount of income from the gross total income. So, gross total income minus deductions under section 80C to 80U, we will get the net income or taxable income. Thank you.